His paycheck just arrived, exactly the same hourly rate he earned 2 years ago. But the grocery bill he paid this morning is 30% higher. Gas prices have doubled since he bought his car. He does the math in his head. The numbers don't make sense. Across the country, millions of workers are having the same quiet realization. The economy is growing. Corporate profits are hitting records. Stock markets are reaching historic highs. Yet the one number that determines everyday life wages barely moves. This isn't just an American phenomenon. The same pattern appears across Europe, Japan, and much of the developed world. For decades after World War II, wages and productivity rose together like two synchronized lines on a graph. When the economy produced more, workers earned more. Then, around the late 1970s, something broke. Productivity kept climbing. Prices kept rising, but wages stalled. Economists call this wage stagnation. But the word stagnation hides a deeper mystery. Because the question isn't simply why wages slowed. The real question is why prices didn't. How did an economic system that once shared growth with workers slowly evolve into one where the gains flow somewhere else entirely? To understand that shift, you have to go back to the golden age of modern capitalism. In 1945, the global economy emerges from the wreckage of World War II. Factories across the United States, Western Europe, and Japan begin producing at unprecedented levels. Demand is massive. Infrastructure must be rebuilt. Entire industries must be created. Labor is scarce. Workers have leverage. Unions represent nearly a third of American workers. In Germany and Japan, corporate governance models require companies to coordinate with labor organizations. Governments regulate capital flows and protect domestic industries. The system creates a simple economic contract. When companies become more productive, when machines get better, when workers become more efficient, the gains are shared. From 1948 to 1973, productivity in the United States rises roughly 97%. Real wages rise almost exactly the same amount. The two lines move together. Think of the economy like a giant pie. Productivity growth makes the pie larger every year. During this period, workers receive a stable slice of that pie. If the pie grows 5%, workers' income grows roughly the same. But by the late 1970s, several forces begin quietly rewriting the rules. Globalization accelerates. Manufacturing begins moving across borders in search of cheaper labor. Automation reduces demand for routine factory work. And financial markets undergo a transformation that shifts corporate priorities. The new philosophy is called shareholder capitalism. Before this shift, corporations balance multiple stakeholders: employees, customers, communities, and investors. But in 1970, economist Milton Friedman writes in the New York Times that a company has only one responsibility: maximize shareholder value. Within a generation, this idea becomes the operating system of corporate America. And once that happens, the mechanics of the system begin to change. Imagine the corporate economy as a pipeline with three main outputs: wages, reinvestment, and profits. When productivity increases, when companies produce more value, those gains must flow somewhere through this pipeline. During the post-war decades, much of that value flows into wages. But after the 1980s, a new outlet begins absorbing a growing share: financial returns. Stock buybacks explode. Dividends increase. Executive compensation becomes tied to share prices. Instead of distributing productivity gains to workers, companies channel them into the financial markets. The pipeline hasn't stopped producing value. It has simply redirected the flow. At the same time, workers lose negotiating power. Union membership collapses in many advanced economies. Global supply chains allow companies to move production anywhere. Technology replaces routine labor faster than new middle-class jobs appear. The bargaining table tilts. Employers gain options. Workers lose leverage. And that changes the wage equation. But here's the paradox. Even as wages slow, prices keep rising. Why? Because prices aren't determined by wages alone. They reflect the total cost structure of the economy: energy, housing, supply chains, corporate margins, and monetary policy. And over the last 40 years, several forces have pushed those prices upward. Housing markets become financial assets. Healthcare systems grow more complex and expensive. Education costs skyrocket. And central banks expand the money supply to stabilize financial markets during repeated crises. In other words, the cost of living continues to climb even as labor's share of economic output declines. Then comes the catalyst that exposes the imbalance: the pandemic. In 2020, global supply chains fracture overnight. Governments inject trillions of dollars into the economy to prevent collapse. Demand returns faster than production capacity can recover. Prices surge. For the first time in decades, inflation becomes impossible to ignore. The answer appears in the data. Since the late 1970s, productivity in the United States has grown more than 70%. But median wages have increased only a fraction of that amount. The missing income didn't disappear. It moved. Much of it flows into corporate profits, capital gains, and asset prices. Stock markets rise. Real estate values climb. Financial wealth expands dramatically. But those gains concentrate among people who own assets. And that changes the architecture of the economy. Understanding this shift gives you a simple framework for analyzing modern financial headlines. Whenever you see rising profits alongside stagnant wages, ask 3 questions. Who holds the bargaining power: labor or capital? Where are productivity gains flowing wages or financial returns? And which assets are absorbing that value? Because the wage-price puzzle isn't really about inflation. It's about distribution. The worker checking his paycheck in 2022 isn't witnessing a temporary anomaly. He's seeing the outcome of a structural shift that began nearly half a century ago. Wages didn't stop rising by accident. They stopped rising because the rules of the system changed. And prices didn't stop rising because the system itself never stopped generating value. The difference is simply where that value goes. Understanding that distinction doesn't predict the next crisis, but it reveals something far more important. It exposes the architecture of the modern economy, the invisible plumbing that decides who benefits when growth arrives. And once you see that structure, every headline about inflation, corporate profits, or stock market records begins to tell a much clearer story.